Hi, I'm Sam Slater from FundCalibre, and today I've been joined by Kunjal Gala, co-manager of the Hermes Global Emerging Markets SMID Equity Fund. Hi, Kunjal.
Hi, Sam. Thank you very much for having me on the podcast.
Emerging markets obviously encompass a lot of countries and a lot of different regions. So for the benefit of our listeners, could we perhaps split it into three with Asia, Latin America and EMEA, or it's emerging Europe and the Middle East and Africa? Starting with Asia, it represents about 2/3 of the companies in your portfolio at the moment. How come this area seems to throw up more opportunities?
Yeah, that's an interesting question, an interesting way to begin and think about emerging markets generally. So, back in the 90s, the composition of emerging markets was quite different. You did not have large economies from Asia as part of the benchmark, whereas Russia, South Africa, Turkey, Latin America, these were very large, meaningful components of the benchmark, and hence a lot of opportunities probably came from those countries. However, since the last, I would say, 20 odd years, a lot of things have changed. The first thing, if you think about Asia, it's a heavily populated region of the world. And it's not just population for the sake of it. There is a very large middle class population in Asia, which you don't find that much in EMEA or LATAM. And when you have a large middle class, the consumption expenditure generally is on a rising scale. Because middle class, these are educated, literate people, not much leveraged balance sheets, and they are aspirers, right? So they like to work hard. They like to come out of the lower income brackets, and hence, you see a rising scale of consumption. So that has been a major driver for Asia. The second aspect, which is also very interesting, is Asian economies have a long history of investments in physical infrastructure and also digital infrastructure recently. And when infrastructure spending happens, there is efficiency, there is productivity, and those economies can grow a lot faster than those economies who are not prioritizing infrastructure. And that's why Asia has become a very relevant part of the benchmark and our investment universe. And finally, it's a reform. Again, this Asian region, has gone through turbulent times in the past. I mean, if you recollect back in the 90s, early 90s, we had the Asian financial crisis. In 1991, India had an external crisis after which they opened up their economies. China also opened up their economy back in the 60s. And then recently, last 7-8 years, we've been hearing about China deleveraging, SOE reform. So this region never lets a crisis go waste, and there is always reform that happens. And again, that also adds to competitiveness of the overall region, and hence opportunities to come out from here. And in contrast, if you look at EMEA and LATAM, while these regions do have some very strong capabilities, especially in terms of resources, you have a lot of oil in the Middle East, in Russia as well. You have a lot of gas. In South Africa, you have a lot of precious metals. In Sub-Saharan Africa, in parts of Sub-Saharan Africa, you have metal, which is very important. Brazil has got a lot of iron ore and other metals. You have Chile, you have Peru, known for copper. But the problem is, as the world moves ahead in a low carbon economy, the resource intensiveness is going to decline. And unfortunately for LATAM and for EMEA, they haven't really benefited or made very good use of the upside that they had many years from rising commodity prices. But now, unfortunately, we are in a different world. These two sets of regions have not really invested that much in digital infrastructure or physical infrastructure. They don't have a sizable middle class population. Inequality is very high. So you either have rich or the poor. You don't have anybody in between. And the pace of reforms has been very sluggish over there. So that's why, we tend to find more opportunities in Asia as opposed to LATAM or EMEA.
That's really interesting. Thank you. Just as a little follow-up on that one, the Latin American countries, my understanding was that over the past few years, for the first time, 4 out of 5 or something have business-friendly leaders. Do you think that now might be the time when Latin America and EMEA actually respond to this and realise that they are behind in infrastructure, etc., and that over the next, say, decade, we could see them trying to make a comeback from that point of view?
I mean, that was the hope. It did happen. Some reforms did get passed in Argentina, for instance, but then the reform-minded president lost the elections, and now and Argentina is the leftists who were governing the country before him and made a mess out of the country, and now again Argentina is defaulting. So yes, I mean, occasionally you do have these economies swing. It's like a pendulum, right? It swings from left to the right and right to the left. So it's again a kind of a similar story there. We've seen in Brazil, again, from the time of Lula and Dilma to Bolsonaro. Bolsonaro is supposedly more reform-minded, pro-business, and we've seen some reform last year. But whether the pace of reform will continue going forward or not in Brazil is again another question, because they have a lot of reform to be done. And these reforms are not going to be easy, both from political standpoint and also from an implementation execution standpoint. And whether the population in Brazil has the appetite to digest those difficult reforms, because reforms are never easy. It's like a bitter pill, swallowing a bitter pill. So again, we'll have to see whether the pace of reforms continue in this part of the world. And then finally, Mexico. Again, this country did pursue some reforms, but after AMLO was elected, the focus of the administration is more, not so much on reform, but more on anti-corruption. A number of contracts which were initially awarded have been cancelled. So policy uncertainty is actually quite high in Mexico. And as a result, the country and the economy and its markets have been suffering even before the virus kicked in. So yes, while a few countries do have seen pendulum swing to the right, but they have swung back to the left in no time, and the economies are kind of sluggish, I would say. So I fail to see much optimism beyond what we have already experienced last few years, unless there is a decisive move by some of these administrators that we have to reform and we have to go on the path of reform. But otherwise, I see a difficult trajectory for these economies, and the potential growth rate will probably remain lower than the developed market growth rate, which is not why one wants to be in emerging markets. You want to be in EM because it gives you better growth than DM. But unfortunately, for some of these economies, because of lack of reform, lack of investments, the potential growth rate is going to be a lot lower than what it has been in the past.
So presumably in those two areas of Latin America and EMEA, it's really down to very specific stock selection for the exceptions to the rule, then those companies that you can find that are going to be able to grow.
Yes, so stock selection is very important anywhere, not just EMEA or LATAM. But in EMEA and LATAM, the top-down asset allocation is actually even more important, because these economies are quite vulnerable. So one has to precisely understand when is the time to go overweight some of these countries or remain underweight or neutral, because these are high beta economies. And there will be a time, like in 2016, we saw Brazil, for instance, rally significantly, on back of bottoming of commodity prices and also developments in the political landscape. So I think those things one has to bear in mind, that although these economies are probably not going to be strategic from an investment perspective, but there will be moments in between when these economies do give you an extra return. But then one way we focus on these things is nobody can really time these things perfectly. So rather the focus should be on, as you rightly said, stock selection. So identify a few handful of good quality companies that are thriving even in a difficult environment, adding to their capabilities, becoming more competitive, and those companies that are benefiting from some structural drivers. And we do see a few structural drivers emerging in LATAM or EMEA. Healthcare is one area, e-commerce is another one, fintech is another one. Um, so there will be some pockets of opportunities that will are opening up in these areas where one can invest rather than investing in, say, a commodity company or a miner, which could be extremely cyclical and risky at times.
And an Asian fund manager that we spoke to recently said that Europe's changing attitude towards China was more of a worry for him than the US trade wars. Would you agree with that? There's this whole talk about bringing manufacturing back home to developed markets. Does that worry you in any way?
So I'm not too worried about Europe and China. I'm more worried about US's attitude to China rather than Europe. The reason is very simple. While China is dependent on Europe for exports to some extent, but the dependency on US is a lot higher. It's not just exports, but it's also technology. So to that extent, US-China is worries me, and how China can come out of the issues that the US keeps throwing at them. Like just recently, they added one of their major, like in addition to Huawei, they added Fiber Home, which is another company involved in 5G infrastructure rollout in China. They added this company to their entity list, making it difficult for Fiber Home to access technology from Americans. And that has a risk on China's 5G rollout unless they're able to find good quality alternatives from Taiwan or Korea or Japan, which they might be able to, but quality is always a question mark, and American semiconductor technology is proven and they are much higher efficiency and much higher quality products. So having said that, moving on to the question that you asked. So yeah, I'm not super worried about Europe's changing attitude to China. China has been investing in Europe a lot. They have poured in tens of billions of dollars in Europe by acquiring companies, by investing in infrastructure. So to that extent, China is not unwelcome in Europe, unlike the US. And there are some differences that are appearing within the European Union about China. Some countries are obviously worried about China. Some countries less worried about China. But that doesn't really worry us that much, because no matter what Europe does or what any other country in the world does, the competitiveness of China in manufacturing at scale at a reasonable price is not going to go away anytime soon. Because China has invested in world-class infrastructure, as I mentioned earlier, right? Also, China has a very large population base. So people don't manufacture in China only for exports. They manufacture in China for the domestic population as well. So to that extent, China gives a very large economies of scale. So yes, on the margins, a few companies here and there will shift some of their lines away from China into, say, Vietnam or in India or in US or Europe. But nobody's going to shift everything lock, stock, and barrel. So to that extent, I'm not that worried about some companies, MNCs, deciding to bring manufacturing back home, because In reality, nobody can fold their operations completely from China. The dependency on Chinese components, Chinese manufacturing will remain because that's the most efficient place in the world to manufacture a number of products. And China itself, the strategy has changed, over the last several years. I'm sure you must be aware of Made in China 2025 strategy, which has been quite controversial with President Trump. Nevertheless, China is going to go ahead. They have already announced trillions of dollars of investments in that space. China wants to move up the value chain. It's as simple as that. They don't want to be known as manufacturers of toys for the world, for instance. They would be very happy, to shift some of those lower value-added manufacturing to other parts of the world, while they want to focus more on AI, cloud computing, data science, and data analytics, semiconductors. They want to be on the cutting edge. Obviously, it will take time, but that's the direction in which China is traveling. They are not looking to increase their share of manufacturing, especially low-end manufacturing is something they're not very keen on anyway.
And you've mentioned a little earlier in the podcast about infrastructure, growing middle classes, healthcare and technology, which are themes that you've had within the portfolio. Have any of them been impacted more positively or negatively by the pandemic, or has it actually thrown up another theme that you're perhaps considering?
Yeah, so healthcare generally has been resilient, especially the importance of quality healthcare is now quite evident. The role of technology in anything, rather, it's just not just delivering healthcare, but the way enterprises conduct their businesses in the future, the role of digital technology, online technology, automation, Internet of Things, everything is becoming more and more important as a mitigation for the disruption that we are seeing, and also to make sure that the business continues regardless of the external environment. And also role of technology in how households, people like you and me, how they behave, their preferences, etc. So technology has a very important role to play in all of those things. We are seeing a few new areas also emerging. For instance, insurance. We are hearing from a number of insurers in emerging markets that the attitude of individuals towards health insurance and life insurance has changed. Insurance was never considered as mandatory by retail investors in emerging markets, but the pandemic has opened their eyes and they have understood the importance of having insurance. And there is a huge gap, a huge protection gap in emerging markets. And that's a huge opportunity for financial services companies to tap into and monetize over the next many years. So yeah, we are seeing the traditional areas like healthcare, technology, they are holding up quite well. And new areas like insurance also emerging as potential winners from the pandemic.
And just finally, please, what's your general outlook for emerging market equities over the next 5 years or so?
I would like to first thank you for asking me that question, and especially for asking me 5 years, not the next 6 months, because 6 months is something which is very, very difficult. But yes, over the next 3 to 5 years, I'm very positive on the outlook for emerging markets. One should not classify all markets that are classified by MSCI as emerging markets, because not all of these markets are emerging. A number of these markets are actually moving in the opposite direction. For instance, Turkey or South Africa or Argentina, Mexico. And for the reasons I mentioned earlier, not having a sizable middle class population, or not having invested enough in digital or physical infrastructure, or not spending time on reforms, some of these economies have fewer prospects for increasing their potential growth rate in the future and reducing their vulnerabilities, macroeconomic vulnerabilities. So yeah, if you exclude some of these economies, then the outlook for rest of EM, for instance, China, India, Taiwan, parts of Southeast Asia, I think those countries do stand out from a longer term perspective. Also, I would like to highlight that there are a number of interesting changes that are happening on the ground across EM. These changes are happening in areas like technology. For instance, 5G rollouts are happening at a decent pace in many parts of EM, and this will also help or enable a number of other advanced technologies to be deployed, like AI or cloud computing, etc. We are seeing a very strong move towards digitization and Internet of Things. Outside of technology, financial penetration remains quite low. I already spoke about insurance, but generally availability of banking services, mortgages, credit cards, personal loans, etc. is quite low. Penetration is quite low across EM. So we see potential for rising financial inclusion. Healthcare, another area which I spoke about briefly earlier, is also quite interesting. We see consumer expenditure, premiumization, those long-running themes also quite relevant in the future. And infrastructure logistics are also quite important. So I would say there is a lot of stuff happening on the ground across EM where there is good value to be made and good opportunity for capital appreciation over a 3 to 5 year period.
That was fascinating. Thank you very much indeed for all that information.
Okay, very good. Thank you so much.
If you'd like to find out more about the Hermes Global Emerging Markets Mid-Equity Fund, please go to FundCalibre.com and please subscribe to the Investing on the Go podcast. Please note that these are unprecedented times and markets can react very quickly to news. The views expressed are at the time of recording and could change. Please remember we've been discussing individual stocks to bring investing to life for you. It's not a recommendation to buy or to sell. The fund may or may not still hold these stocks at the time of your listening.